A new wave of tariffs is coming, and they're supposed to fix America's trade deficit. But they won't. That's not a political statement. It is an economic and mathematical fact. There's only one effective way to reduce a trade deficit. And as we will see, it's far too costly. To understand this, we need to go back to the 1930s. During the last period of protectionism, the economist Lerner introduced what became known as the Lerner Symmetry Theorem. Lerner proved that a tax on imports is effectively the same as a tax on exports. Raising barriers on imports actually reduces the amount it's possible to export. That sounds counterintuitive. After all, tariffs are supposed to protect domestic industries by reducing competition from abroad. But Lerner showed that because we have a foreign exchange market, there has to be a balance of payments, a balance of trade, and a balance of exports and imports. As a result, tariffs can cut imports, but they will also cut exports by an equal amount, literally pound for pound and dollar for dollar. The reason for this is because the foreign exchange market adds an additional element to trade. To illustrate that, let's look at how different exchange rate regimes work, starting with Britain and the EU. If British people want to buy French cheese, German cars, or Italian handbags, then there is a need to convert pounds into euros. The situation is a bit different for a country like Luxembourg, inside the Eurozone. If every Luxembourger decided to spend wildly on German BMWs, Italian designers, and French food and wine, they could potentially drain the country of money because they all use the same currency. It's very unlikely, but it is possible. But the UK isn't in the Eurozone. The pound is not legal tender in Paris, Berlin, or Rome. So if Brits want euros, they have to buy them. But for that to happen, Europeans must also want to buy pounds. And that only happens if Europeans are getting something in return, either British exports or UK assets. That's the key. Every euro spent by a Brit has to be matched by the equivalent in euros spent by a European, either on British goods, British services, or British investments. Just like any market, the FX market clears when there is a balance between buyers and sellers. If there's too much demand for euros, the pound falls. And as it falls, foreign goods become more expensive and British exports become more attractive. There is a constant rebalancing through the exchange rate. The FX market is probably the most efficient of all the financial exchanges, so these adjustments happen very quickly, pretty much instantaneously. But the key thing here that I want you to remember is that the market will balance the demand and supply of euros and pounds. Buyers and sellers are matched one for one. Now let's go back to the tariffs. Let's say Britain imposes tariffs that make European goods more expensive. That would result in Britain buying fewer imports, say 20% fewer European goods. If that happens, then Europeans will end up with 20% fewer pounds. Just consider that point for a moment. Britain bought about £300 billion of goods from Europe last year. If that fell to £240 billion, then it's quite clear that Europeans would now only have that reduced amount with which they can buy British goods. Put another way, with 20% fewer pounds, Europeans will have no choice but to buy 20% less British goods. It's not politics, it's maths. And what is becoming clear is that while tariffs do reduce imports, they also reduce exports by exactly the same amount. Now this leads us to the obvious question of, if there has to be a balance of trade, then how come America is running such a large deficit with China? Well, that is a result of the capital account, the other half of the balance of payments. While the current account measures trade in goods and services, the capital account tracks financial flows: stocks, bonds, real estate, factories, and other investments. For years, China has been accused, often with good reason, of suppressing the value of the yuan by recycling its trade surplus into US Treasuries. Instead of using dollars to buy American goods, China buys American debt. This keeps the yuan artificially weak and Chinese exports artificially cheap. From China's perspective, it's a win-win. They grow their export sector, maintain currency control, and earn interest on safe dollar assets. From the US perspective, it's destroying US industry, factories are closing, and US jobs are disappearing. It's not hard to see why there is a growing element of dissatisfaction in the US, and why we have ended up with President Trump introducing widespread tariffs. The logic goes, if we stop cheap Chinese goods from flooding in, maybe our own factories will come back. But it's a mistake to think that, because Lerner's logic still holds. There has to be a symmetry, and there has to be a balance of payments. China buying US financial assets creates a capital account surplus that can only be balanced by either an equal and offsetting current account deficit in goods and services, or an equal and offsetting purchase of Chinese financial assets. Now, there isn't a lot of demand in the US for locally denominated Chinese government bonds. That is why the US deficit with China in goods has been so persistent. And introducing tariffs won't change the dynamic of the relationship. Tariffs will make imports more expensive and by doing so reduce them. But as we have seen, exports will also reduce by the same amount and the deficit will remain. So, is there anything that actually could reduce the trade deficit? Well, yes, there is. But it comes at a price. The only way to eliminate the trade deficit would be to stop China from buying American assets altogether. No treasuries, no real estate, no equity stakes held through offshore shell companies in the Caymans. And the problem with that is, if China stops buying treasuries, US government borrowing costs spike. Interest rates rise. Over the past few years, US 10-year bond yields have already increased from well under 2% to close to 4.5%. And the One Big Beautiful Bill Act is expected to add another $4 trillion to the national debt. Preventing China from buying treasuries would make this debt even more expensive, probably significantly more expensive. There is actually a risk that it could trigger a debt crisis. Now I have produced another video on the potential debt crisis, so if you are interested in watching more, a link will be provided at the end. But to conclude our video, the huge costs of stopping China from buying US treasuries means that no one will even try to use this option. And if there is a capital account surplus, then the deficit will remain, no matter what level of tariffs you apply. A link for the next video should be on your screens now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe and comment. Thanks for watching.